Dave.
Good morning, Dale. How's the sound over there? Everything, you can hear me okay?
Real clean, buddy. How are you?
I'm doing really well. How about yourself? It's been a while.
Yeah, we've gotten a little bit older. Huh?
Yes, unfortunately, that is the truth, isn't it?
It's better than the alternative. So you're on the West Coast too, Dave. So I get up at 3:30. What time do you get up?
Yeah, you got me beat by a half hour. I get up at 4, and I think it's like the best time of day to get up. It's the only time where I actually have time to think without being distracted by life.
Yeah, the world is still asleep. Reminds
Exactly.
me of that scene on Wall Street where Gordon Gekko's on the beach. He already made like 800K in Hong Kong gold, and he's calling Bud Fox. And I also wrote a poem about our lifestyle. Tell me if you agree with it.
Okay.
Our life is like that of a farmer, up before sunrise, asleep after sundown. The only difference being that we nurture seeds of greed for the harvest of pips.
Very well stated. Very well stated.
So have you been successful in bringing out the greed in people lately, Dave?
I don't know about the greed necessarily. I mean, I've been in this business a long time, 20 plus years. And I think for me, and again, I'm making a little bit of a speculation here, but I don't think I'm far off. I think 2018's actually been, for anybody who's got some chops in the game, it's been fantastic. I don't know if, people
like the two-sided markets now, right?
Pardon?
Yeah, you're happy to see indexes trade both ways.
Exactly. I mean, there's price discovery, for crying out loud. Imagine that. Yeah. So I think, if you're relatively new to the game and you've been involved, let's say over the last 2-3 years, this might be a kind of like a holy crap moment. For guys like you and me who've been around the block many, many times, this is like,
the old days.
Well, it's not only like the old days, but to me, it brings out it allows you to kind of exercise what you do well on a day-to-day or a week-to-week basis. So, bottom line for me, 2018's been a joy. I mean, until we got to February. January was the same old nonsense. Grind higher every day, scratch your head, don't try to overthink it. Don't try to rationalize it because that was stupid. But, since we got into February and then into March, it's been great. So I'm hoping that this is kind of a shift back to a more price discovery oriented market. And if it is, that's fantastic. And if it is, and you're new to the game, you're going to have to kind of put on your thinking cap and really, think differently about how you're going to trade the market. So, hopefully we'll talk a little bit about some of those tenets today and show you what I'm looking at, give you a sense.
You're a veteran, Dave, so I know we have increased volatility in equities. You could go home with a great close, and then in the afternoon there's a tweet or there's an FBI raid, and the S&Ps are down 40 in the afternoon. Are you surprised with all the volatility that we're getting in indices that we're not getting the same type of volatility in FX?
It's an interesting question. We did a trader meetup a couple of weeks ago down in Marin County. I was down there visiting, and I hooked up with JC Parrots and my colleague here at Aspen Trading, Brad Simpson, and we did a trader meetup. And that was one of the things that came up. Christian Kerr was at the meeting, and for those of you that don't know, Christian Kerr is
he's excellent.
Yeah, he's a veteran.
He does a lot of GAN, doesn't he? I've interviewed Christian.
Yes, he does, and he's got a pedigreed background in the FX market. Spent a lot of time on the institutional side, and he brought up that exact point. He said, despite all this volatility, the G10 FX volatility is still in the toilet. Yeah. And I actually have got a chart of it. I can probably dig it up while we're on this webinar. And for me, that really struck true, and it really I'm only able to really right now in FX land, I can really only watch the Euro and Dollar Canada. Those are the only ones that actually have some movement that might be somewhat forecastable, for lack of a better term, but the lack of volatility in FX is really quite puzzling given that it's such a major asset class.
You know, a possible explanation is that the market doesn't believe there's going to be a trade war. But should that really manifest, it will then begin to manifest in the currency markets and volatility will explode. So right now, the equities are worried about it, and the FX market is discounting that it's not going to happen. That's an explanation that I've read, and I ask a lot of veterans about it, because if the trade war was ongoing and, you know, we have another 60 days, who knows the way things change every hour, what's going to happen in 60 days. But if the tariffs go into effect and tit for tat, then I think you'll see an explosion of volatility, increased ATRs. That'll tell you the trade war is real when it shows up in FX. That's what I've read.
And that may very well be the case. And, you know, that type of a scenario is kind of like what we dealt with in the S&Ps for the last several years, or any of the major indices. You could come up with any number of logical explanations, but it didn't really help you make any money. You know,
yeah, there you go.
Bill Fleckenstein is a friend and a colleague of mine, and he's always famous of saying, you know, obviously he's usually looking for the market to break to the downside, and his philosophy is, you know, shoot him in the back. You know, let the market break, whether it be up or down. But he's, you know, in this case, he's talking down. Let it break lower first, rather than trying to be the hero and isolate the top or isolate the bottom. And I think that is very, very sound advice. And I think most people know that intellectually. Whether or not they do it on a practical day-to-day level, maybe not. I mean, I'm guilty of it every once in a while. I'll think I'm smarter than the market. But as it relates to FX, you know, eventually, yes, the volatility will come back. And when it does, it'll be welcomed with open arms. In the meantime, you know, luckily, since I'll trade across different asset classes, albeit with a very narrow focus, I've got plenty to keep me busy in terms of the S&Ps and 10-year notes. So, you know, there's plenty to do until FX lights up. But I do think there's a couple trades here and there in FX. We're just not getting that robust move that we would like to see.
I hear you're a fan of Grega Horvat.
Grega. Oh my God, I've known Grega for a long time. We've never actually formally talked on the phone, but we've exchanged many emails. Obviously, we share a kindred spirit in terms of Elliott wave.
Yeah.
Which of course a lot of people poke fun at. They call it voodoo, they call it whatever, and that's okay. But for me, and I'm sure Grega would agree, it provides a structure and an objectivity, which is a word that most people don't associate with Elliott wave. But I think if you really look at it, it can be objective. So yes, I know Grega. I think we approach the market. Oftentimes we'll come up with similar conclusions, which is a good thing to see.
Yeah. So, you know, I say it so, you know, knowing that you guys, you know, see a lot of things similarly, and I know that there are e-waivers that see things differently. I would say fade Grega and Dave Floyd at your own peril.
Well, I'm sorry, what was that last part, Dale?
Fade Grega and Dave Floyd at your own peril.
Well, I appreciate that very much. But, you know, I think a lot of it goes, you know, again, it boils down to like anything in life. We've got a lot of, you know, years under our belt, and I think that really goes a long way. And, you know, it's one thing to be kind of approach the market as an engineer where everything's A plus B equals C, but the markets aren't like that. You've got to have a degree of flexibility. And, you know, again, probably a well-worn phrase, trading is an art form on some level. There is a scientific aspect, but there's also an artistic. So you got to unlock that creative side of your brain for sure.
Okay. So let's get creative with your count here in the S&Ps. Looks like you have the end of 3 up at potentially 2775.
Yeah.
Does that imply a 3 is completed there, a pullback, and then new highs?
Well, let's do this. Let's kind of mix it up a little bit. Let's go back in time, shall we? And let's go back to that lovely, and I mean this in all due seriousness, let's go back to this lovely phase of the market back in late January, early February.
Love Niagara Falls.
I love it too. It was, you know, February and March were very kind to me. My managed accounts were up, and suddenly people realized that active traders actually know how to do something in the market. But at any rate, what I'm going to actually change this count, or at least offer an alternative on this webinar, because I think things are changing. What I had been looking at is that this low here, back in early April, may very well have been the completion of wave 4. Now, it's possible it would have been a truncated wave, you know, where you've got wave C ending at about a 618 projection of wave A, which not uncommon, or, you know, it's not that it's out of the possibility, but it's not terribly common. What's got me rethinking that, though, is this price action right in here, and I can zoom in. But to answer your question, prior to, let's say, all of this price action over the last couple of days, I was thinking that we could probably go up to around 27.66. But because, you know, if we had completed wave 4, that would have been wave 1 up, wave 2 down, and then of course the natural progression would be for wave 3. That could still play out. Again, it's anybody's guess at this point. But when I look at this type of price action, I'm just going to zoom down to a 2-hour chart to kind of get a little bit more granular. This to me is a bit, I don't want to say troubling, but I can't really get my head around that. If this is a wave 3, this is not the type of price action that would be indicative of a wave 3.
Yeah, a lot of overlaps. Is that what you're saying?
Exactly. I mean, this could be a leading diagonal right here. This could be wave 2. So yes, that's all possible. And I know some people on the webinar here might be going, oh my God, that's just far too much ambiguity. I need clarity. And I get that. But again, the markets don't always unfold like that. I don't think there's any indicator or approach you can put over a chart like this and walk away with any degree of certainty. There's always going to be some ambiguity, and you have to account for that. So that being said, it's possible that we've got the A wave down, we've got the B wave. This might be simply wave A of that final C wave. This would be wave B, and then that takes us down to around 2450. So let's just do that just for ease of illustration. Let's just blow this up. Get rid of this. So what I'm basically doing here is I'm basically starting to arrive at a conclusion that it's possible that that we may not be complete yet in terms of our downside price action. And that's not going to work. Let's just do this, make it a lot easier. So this would be the A wave down. We'd be in wave B right now. And for those of you that are wondering, I'm using a program called Motive Wave, which makes, as you can see, makes labeling my charts much easier than having to go in and manually label them. So let's do a little brief Elliott wave education in here. If we assume that this particular forecast is correct, we've got the A wave down in 5 waves. Now we're grinding, overlapping higher on wave B. Wave B is typically going to retrace about 618 the distance of wave 1, or I'm sorry, of wave A. Well, right now we're in between the 50% and the 61%. So if you wanted to get super scientific, we would say that 2709 is really the level that's going to be key. I'm not so optimistic that things nail that price exactly, but I would expect that if this forecast is correct, that prices are going to start chopping in and around this area and then lead to one more leg lower, which could take us down to 2450. And naturally, if we move lower, the volatility, of course, in the market's going to come roaring back. Obviously, this market to the upside is very labored. You know, I don't wed myself just to the technicals. I do look at other things like quantitative analysis and stuff. And I still think overall that what we've seen since the February break lower is a very labored market. It doesn't mean that we couldn't go to new highs. It just, this is not the type of price action that suggests that to be the case. So I would say based on, as you correctly pointed out, Dale, how we're overlapping and grinding higher here, this type of a forecast makes sense to me. Right now I have no position in the S&Ps. We've been trading the S&Ps periodically given the volatility. Right now I'm flat and trying to look for what that edge may be. And, this is one scenario that makes sense to me. I looked at it this morning and I said, this is probably the higher likelihood in here. I'm a little uncomfortable being a buyer in here. But, time will tell. I don't have any skin in the game right now, so I can sit back and be objective and evaluate accordingly. I don't have to talk my position right here because I don't have one.
Isn't that a nice position? And
It
don't you see the market clearer when you're flat than when you're in?
Exactly, and you don't always have to be in. Just because the markets are open doesn't mean that you've got anything to do, and that's obviously that's a tricky part for a lot of people.
That's the hardest part for most people.
It is the hardest part.
Around and waiting for the setup that's so compelling. I like to say, Dave, that the best trades are the ones that you have so much confluence and a great case to assume risk, like a great attorney going into court, not with one piece of evidence, but a stack of it, and that you would feel worse seeing the trade work without you than being stopped out attempting it.
Exactly. And it's really easy to get sucked into not waiting for that because we have at our disposal nowadays, again, I'm stating the obvious, but we have so much information at our fingertips. It's really easy to listen to me right now and say, well, geez, Dave's got nothing going on. I need something. I'm going to go listen to this guy or this gal. And that's where people make their fatal mistakes. You've got to find what works for you, stick to it. You may go a week or two without making a trade. 80% of the time or 80% of the money I make is usually in 20% of the time that I'm trading. It's lumpy. It's very lumpy.
So is there any other instrument you want to give us a view on?
Yeah, for me, what's been working the best this year, and I also like the way it trades in a more gentlemanly manner, as I like to call it, is 10-year notes. I love the way 10-year notes trade. I happen to be short them. I've been short them off and on. I don't think we've had any longs in 10-year notes this year because let's just simply look at the big bird's eye view. Again,
I've seen this labeled as an ABC4, which implies new lows, which
exactly
probably gets us to the over 3% yield on the 10-year.
Yeah, that's going to be the key thing. I mean, this is the 10-year note chart. Clearly, the trend is down. As I have it labeled, that suggests that we're going to head down towards 117.25. We are short at two prices. We're short from 120.28.5, 120.19. I've got a stop loss, and when I say stop loss, I'm going to reevaluate at this level. I'll look at it and say, yeah, this still makes sense, or I got to get out. I got to get the heck out of here. We had a little overlap here over the last couple of days, which is great. We got below 120.16, so I'm pretty confident that we're going to move lower. But you bring up a good point, or the corollary to this is just 10-year yields. So let's just take a look at those. Again, 3%, that is the magic number. I would actually argue 295 is the magic number because that's where we topped out about a month ago. If we can get above 295, and if we assume that wave 4 is complete, which is what I am at this point in time, then 10-year yields are going at minimum to 327. Now that brings up a whole, I'm sorry, go ahead, Dale.
No, okay. You know me, I'm always looking ahead of it. I kind of think this is a layup, although nothing is.
Yep.
I'm looking at your wave count on both the yield chart and the notes, and I mean, we'll be completing something up there, Dave, and either wave 1 or I think you had 3 on the notes. There could be a pretty good sink in yields and rally in bonds after this final decline that we're looking for in bond prices and rise in yields. Are you looking that far ahead, or just
No, not really. I'm just looking. I'm really focused on this 295 and the 3% yield. So I'm just looking for that next leg of yields to go to 327. And then if we just flip back to the 10-year note, that moved to 327 or anywhere above 3% in yields, drives us home towards this this ideal quote unquote 117.25 or 117.23 price target.
Okay, so explain the difference, because you have them both being as an ending wave. You have a 5 there in June and a 3 underneath, which I'm assuming that's 5 of 3, and then a wave 4 can ensue. And on the yield chart, you have it just completing wave 1. So
yeah, you don't always get the instruments to line up exactly in terms of the wave count, but if you get them directionally, you're still going to get the same impact. Either way, I think, as you said, looking ahead, yes, you're correct. When we get down into this price level, I suspect it will be sticky, meaning prices are probably going to have a hard time moving lower. If you are a counter trend trader, which many people are, yes, there's the opportunity for you to get long notes down there, and then we'd get some sort of a retracement higher in wave 4. I don't know if I'll be playing that. I don't tend to be a counter trend trader, although I'll take a couple shots here and there. I'm just more comfortable sitting here in the direction of the trend. And what I really like about 10-year notes lately is that you're not getting that. It's funny, we started off talking about how we want volatility. You're not getting a lot of volatility in 10-year notes, but what you are getting is
you know what I really noticed, Dave, and you've been around, is during these 600-point sell-offs in the Dow, there's been relatively little flight to quality into bonds.
Absolutely, and that to me is very telling.
That's kind of a danger sign that, to me, that if they can't rally under what should be favorable conditions, there's trouble in River City.
That's I think that's a very valid point. That's comforting to me when I see that. And again, we started off the conversation saying, wow, we love this volatility. Well, you're not getting a lot of volatility in 10-year notes, but what you are getting is price persistence, and I'll take that too.
Yeah, you're getting a trend.
You're getting a trend, and it's weird. When I'm in a 10-year note position, which is fairly often, I find myself rarely looking at what it's doing because it doesn't move around in an insane manner. You can look at that and say, well, there's a lot of opportunities in the S&Ps, and yes, there are. But my God, it can be manic at times.
I can't stomach it anymore.
Yeah, well, I'm in the same boat. I'm not a big fan of trading the S&Ps.
Yeah.
I'll usually do it typically through options. I'll do it through a call spread or something, or a put spread. But I'm with you. That type of movement, I'm just like, it's a little too much for me. I like
besides finding a trading style that suits your personality, like Jack Schwager says, find the right instrument that has the kind of beta that you feel comfortable with. Are you there, Dave?
I am. My mic queued out for a second. I agree 100%. And, for me, I analyze the heck out of the S&Ps, but they're not my favorite instrument to trade. And if I do trade them, I do it through options because it dampens that volatility, which just doesn't work for me.
We're getting a question from the community. Could you give us a quick look on the trendless dollar, and maybe and tell us if you see anything besides sideways there?
Yeah, well, we've got dollar volatility or lack thereof at 10-month lows. So for me, I think the dollar index is key in here, and key from the standpoint of, don't trade yourself into a lather here because I don't really know what you're going to do. So again, for me, I've got this labeled as possibly a completed wave 4. All I know is that we've got sideways chop. I still favor a move lower. Anything below 88.99, I'm back onto building long euros and short dollar CAD positions. Okay. Right now, I've got really nothing. I'm flat in the FX market. I'll show you in a moment. I've got a shorter term, and when I say shorter term, it could last a few days. I've got a shorter term setup that I'm looking at in the euro here. But that's going to require this dollar index to break lower. And again, timing the end of a correction is so god darn hard. There's so many places you could have got your hand slapped in here over the last couple of weeks. Again, I'd rather wait on some level to kind of shoot them in the back, or have a very small position on and allow yourself the price action to move up and down, knowing that you're not smart enough. And I put myself into that category. I'm not smart enough to know when this correction will end, but I think it will. So if I want to be, let's say, long the euro in here, but I'm waiting for the dollar index to break, have a small position on so that you can let it move around and it's not going to freak you out. But my overall forecast, we are moving still lower in the dollar index. I think we get into the 86 level, 87, 86. Then I'll start to consider, you know, unwinding long euro positions. But this is how I see things playing out in the near term. And I think we're getting pretty close to getting that next leg lower. But
Yeah,
again,
it feels that way.
it feels that way. Yeah.
Why don't you take the last few minutes, perhaps show your website and how people could reach you?
Sure.
Follow you. Your Twitter handle is at AspenTrading10.
Sure. Love to do that. Well, you know, the one thing I would
why don't you say hello to Bill Fleckenstein and tell him it'd be a good idea for him to be interviewed by me.
I will let him know. There's actually a couple other people that I swim in the circles with that I think would be a fantastic.
Because he works for a bank still, he told me.
I'm sorry, what was that last part, Dale?
Christian Kerr still works for a bank, so he has compliance.
Yeah, he might be tough. He's at Citibank in San Francisco, so he's probably got that. He's got those.
Also, after hearing about Bill's trading style, if I ever met him, I would not walk in front of him. I'd walk by.
Well, that might be fair, but he's a super nice guy, so I don't think he'd do anything to you, Dale.
All right, buddy.
But you know, the one thing that I have that I would be more than happy to share, obviously, is this. I'm going to be in London on May 2nd. So if you've got anybody either in London or will be in the London area, I'm doing a half-day trading workshop on May 2nd at Duke's Hotel, which is a really nice boutique hotel. We've got 25 attendees at max. We've got about 6 seats left. It's $495 to come and hang with me for the afternoon. It's not going to be a didactic workshop where I'm just talking to you. It's going to be a very, engaging dialogue. I'm going to kind of go from A to Z on how I trade, very similar to what I did today, but in a much more structured format. If you'd like to come, use the coupon code REALVISION, and you'll come for $495 because the early bird registration's over, but there's probably a lot of people on this call who weren't aware of it, so they obviously didn't know about the early bird. But use code REALVISION, and you can get in for $495. Just go to the website, which is aspentrading.com. Click on events, as you can see here, and you will go ahead.
This isn't Raul Paul Real Vision putting it on, is it? It's just you putting it on.
It is just me, but the Real Vision, they were obviously behind it in terms of promoting it to their users. The Real Vision code is from a promo we did with their users. So I'm just using the same Real Vision. And that's another place that you can see me. I do, in fact, I'm filming later today for Real Vision. It's a fantastic outlet if you want to listen to some really good professional traders talk about their craft. So I highly recommend Real Vision. But here's something else. So yeah, I would love to see you guys at the trading workshop in London on May 2nd. It's going to be a lot of fun. Here's something that you can get off the website. I put together a resource list called The List. Just go to the home page and you'll see, you'll have the ability to click on and download the list. It's basically like a 20-page PDF file of, really good resources for traders, software, books, periodicals, and, research services. Highly recommend you do that. And if you're really feeling interested, take a trial to either my FX or stock service. And if you take a trial for $7, I'm giving away, or I'll send you out a copy of this book, Thinking in Bets, which to me is probably one of the best trading books I've read in a long time. It's written by Annie Duke, who is a former professional poker player. And really one of the key takeaways I came away from in that book is that unlike chess, and a lot of people associate trading with chess, and I think that's a bit of a misnomer. Yes, you're thinking strategically like you do in chess, but in chess, it's possible to know all the outcomes. Now, granted, most of our brains can't do that. Some people can, but it is possible in chess to know all the possible outcomes. Therefore, you know what, if you make a particular move, it's going to set off a particular set of, counter moves. We can know that in advance. We don't know that in trading. And I think all of us agonize over, I need to have everything just set up just perfectly in order for me to be correct. And the fact of the matter is, we can't. And it gave me a lot of comfort just knowing, you know what, it's close enough. And oftentimes when we have a losing trade, we beat ourselves up and say, oh, there's something wrong with my methodology. And the fact of the matter is, there's probably nothing wrong with your methodology. It's just the way the markets are. And we don't want to fool ourselves when we're right either. I remember a trade a few weeks ago, we were short the S&Ps actually. And Anthony, was that his name, Anthony Cohn? The guy who resigned from Trump's economic advisory position, Anthony Cohn, or whatever his last name, or whatever his first name was.
One of those Cohns. Yeah.
What's that?
One of those Cohns.
One of the Cohns, exactly. So, and it doesn't matter. Economic advisor in the Trump administration. We're short the S&Ps, and we're holding the position overnight. And that news comes out. S&Ps drop. Now, I didn't know that was going to happen. We got lucky. That didn't make me think that I was any smarter than I thought I might have been when we got into the trade. And the same thing happens on the flip side. Sometimes we're wrong on our trades.
Never against luck, Dave.
What's that?
And $4.95 to see you in London is a lot less expensive than having a date with Stormy Daniels.
Exactly. So, and it's going to be fun in London. We're going to have a great time.
Yeah, you're living the big life, man. You're living the good life, and congratulations. Sounds like you've made a lot of progress and your visibility is growing. Congratulations, my trading warrior brother, and thank you for coming in and sharing your views and philosophy with us today, Dave.
Dale, as always, I really do appreciate it. Let's not make it so long next time, and I will definitely reach out to a couple colleagues and have them have you reach out to them. I think you could get a couple of really sound people in here distilling some sage advice.
Yeah, and and Raul Paul, as long as we're like Old Home Week, I've told him I thought I'd be a great guest for him on Real Vision, but he found a great guest in you, and
well, I appreciate it, Dale. As always, my pleasure, and thank you very much for having me, and thank you everybody for attending and listening to what I had to say, and hope to see you in London.
Yeah, have a great time there, Dave. And may pips rain down on you till we talk next.
All righty. Bye-bye, Dale.
All right, buddy. So that's it for Turnaround Tuesday, everybody. Let me just take a quick look here at something. U.S. dollar Swiss about to do what I was looking for it to do. You're welcome, Kareem. Everyone have a great week. Have a great day. See you tomorrow. Good hunting, and remember, don't just count your pips, count your blessings. You're welcome. Steve Cohn was his name. Gary Cohn was his name. Adios.